Welcome to the advisory group's Insurance Needs for Different Stages of Life workshop. Let's first start with some introductions. My name is William Glenn, and I am a Client Services Associate as one of the TAG team members. Also joining me today are Brent Beverly, the president of the advisory group, and Manny Chinche, an experienced senior wealth advisor at the advisory group. Both of these gentlemen are certified financial planner practitioners and wealth advisors at our Diamond Bar branch. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can help them make an informed decision. We believe that the more you know, the more you will like what we do and how we do it. As a reminder, it is always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. In this workshop, we will primarily be focusing on preservation and tax planning. Our agenda is very straightforward. We'll be starting our workshop by talking about who could benefit from life insurance and why. This will give you some insight for assessing how much coverage you need. We will cover how one determines the amount. We will educate you about different policies and strategies for different life stages and circumstances. Regardless of your age, there are choices you should understand when protecting your family for the future. We'll also be sharing information about the benefits life insurance can provide to business owners to help mitigate business risks and provide other benefits. Finally, we'll talk about the risk assessments insurance companies use when they evaluate you and determine whether to provide you the insurance you want. Just in case you were wondering, we won't be making any specific recommendations. Everyone's needs are different. Our purpose here is to raise awareness of your options and to help you understand the strategies that may work for your benefit. With this information, you should have a better idea of what you need and have more confidence about exploring these options with a valued professional. So let's get started. To explore these points in more detail, I would like to bring up our first speaker, Mr. Chinche. Manny?
Thank you, William. Today we have a lot more insurance options at our disposal than most of our parents did, and that's really important for our own peace of mind and a sense of security for our loved ones. These options allow us to meet different needs. Life insurance provides parents of young children the reassurance that their kids will have financial support if either or both parents die unexpectedly. It replaces the income we would have earned. It can help people who are in their peak earning years protect their wealth while accumulating tax-deferred income. People who are thinking ahead and developing their estate planning strategies can incorporate life insurance into their plans so they can give more to future generations and less to the IRS. Business owners can use life insurance as a strategy to help provide capital at a critical time to secure their business operations in the event there is a change of ownership or the loss of a partner, and for other reasons that we'll discuss later. Some individuals and business owners also like to use life insurance to benefit charitable causes. Life insurance is typically purchased to provide a surviving spouse, children, or other named beneficiaries with the financial support they will need to maintain a comfortable standard of living, pay off debt, and fund future expenses such as college tuition. So how much is needed? As you might guess, it takes a little time to figure out, so a paper and pencil for notes will be helpful at this point. You can start by writing down your routine living expenses along with your net earnings after taxes. That's your take-home pay. You also need to include any outstanding debt, whether it's your mortgage, car, or college loans. On top of that, add in expected future obligations, such as college tuition for your kids and financial support to help your surviving spouse for retirement. Someone who lives on a few $1,000s a month and does not plan to help their children pay for college will likely need less life insurance than someone who has a higher standard of living and wants to help their children pay for college. In these days of two working spouses, how would the death of one spouse affect the surviving spouse's ability to work and manage the family without a supporting spouse? You may want to factor in the additional cost of childcare. Most people seek a death benefit that can potentially cover all of these current and future costs. You'll find different calculators online if you search them out, and you may also see some cookie cutter approaches to buy a policy that provides 6 to 10 times the amount of your annual salary. Another similar approach is to multiply your annual salary by the number of years you have left until retirement. Now, these cookie cutter approaches don't work for everybody, and so they may not give you the peace of mind you're seeking in a life insurance policy. That's why you would want to sit down with a financial professional to analyze your particular needs. The advisory group uses our financial planning software, eMoney Advisor, to help calculate the need, accounting for other factors such as Social Security benefits for children. We help you determine which approach might be the best choice for you. Today we'll be reviewing the two primary types of life insurance, permanent life insurance and term life insurance. Now, permanent life insurance provides lifetime coverage. Whole life, variable life, and universal life fall into this category. Term life insurance provides coverage for only a predetermined time period or term. Now, before we dive any deeper into these, we want to be sure everyone is clear about the terminology commonly used with life insurance. We'll do a quick review next. These criteria are extremely critical to keep in mind when you're evaluating life insurance policies. Premiums are the monthly, quarterly, or annual payments required to maintain coverage. Cash value, not to be confused with face value, is the tax-deferred investment portion of a permanent policy. Cash value provides funds that can be borrowed or cashed out. Convertibility is the option to convert from one type of policy to another, say from term to permanent. Usually this is not required a physical exam. Face value is the death benefit, the stated dollar amount the beneficiaries receive. As we noted previously, face value is not to be confused with cash value. Okay, now that we've covered these key terms, let's move on to term life insurance. This is the not so secret sauce for life insurance. You will want to keep this in mind as we go through the different types of insurances. In all cases, the actuarial tables are the primary source of the cost of insurance. Now, I would like to especially point out that around age 55, the chart of deaths per 1,000 people starts to rise dramatically. By age 100, there are not many people who can expect a long lifetime. Now, I say that jokingly, of course, but it is the truth behind life insurance rates as we delve into the different types of coverage. Now, remember we spoke regarding the fact that people with good health tend to live longer than people with poor health. Before approving any life insurance coverage for you, the insurance company will want to evaluate any potential risks, whether it's your health, finances, lifestyle, job, or other considerations. Some of the most dangerous professions, by the way, are logging, roofing, farming, and piloting airplanes. After evaluating these risks, along with the requested coverage amount, the insurance company will decide whether to insure you. Now, many insurance companies require an in-person medical exam. If you have a complicated medical history, the insurer may deny your insurance request or charge you a higher premium. There are some no-exam policies, but they are usually more expensive and have come with a lower face value. If you request a large policy but live on a modest income, the insurer may question you about why you need such coverage. Some people might think they've got too many medical or lifestyle complications to qualify for any insurance, but there are options that may work for them. For example, there is a survivorship life insurance, also called last to die or second to die policy. This is a contract that insures the lives of two people and pays a death benefit to a beneficiary only after both have died. Now let's look at the primary types of insurance. The first type for us to cover is term life insurance. Term life insurance is typically much less expensive in the short run than permanent life insurance. This is especially true for younger people. As you get older and as your health risks increase, so do the premiums. While there are annually renewable term policies, most commonly, term policies are written for a specific period of time, such as 10, 20, or 30 years. They may be renewable at the end of each term with increasing premiums that can become extremely expensive for older individuals. Level term policies lock in the annual premium cost for periods that can range up to 30 years. Some people choose a type of term insurance called decreasing term insurance. This is a renewable term life insurance with coverage that decreases over the policy's life at a predetermined rate. It's sometimes used as a form of mortgage insurance and can be written to match the amortization schedule for someone's mortgage principal. The face value steadily declines over the term while the premium stays constant. Something everybody needs to remember about term insurance policies is that they have no cash value. Unlike other types of insurance, benefits are paid only if the insured dies during the term of the policy. If the insured dies the day after the term ends and the policy hasn't been renewed or replaced, there is no coverage and the beneficiaries won't receive anything. For that reason, anyone considering term insurance may want to look for a policy that is renewable, say up to age 70, or can be converted to permanent insurance without a medical exam. Now let's look at the alternative. To cover this and some additional elements you need to consider regarding insurance, allow me to bring up Mr. Beverly. Brent?
Well, thank you, Manny. So you've seen and heard the background of life insurance and covered the fundamental form of life insurance, term coverage. Now let's take a look at permanent coverage. That is coverage that's going to last for a lifetime. Now there are many different kinds of permanent life insurance, such as whole life, variable life, index life, and universal life. Now, we don't have time today to review the specifics of each kind of coverage, but you might want to look into them a little bit further if your need is for permanent insurance coverage. If you do, you'll see, for example, that whole life policies have a fixed premium, meaning you'll pay the same amount each year. Universal life insurance policies have flexible premiums, and you can change the amount you pay each year so long as you pay the minimum and have sufficient cash value to maintain your policy. Now, as we noted when we discussed term policies, the premiums for permanent policies are higher in the short run. The reason behind this isn't a mystery. With permanent coverage, the life insurance company is eventually going to need to pay the death benefit. With term coverage, there's a portion of the policies, maybe even a majority of the term policies, that are never going to pay a death claim. So while permanent coverage is more expensive in the short run, it may be more cost effective if coverage is needed at older ages. Now, all the permanent policies have this in common. You're able to combine death benefit protection with the ability to build up your cash value on a tax-deferred basis. Now, this cash value or investment value is designed to build up over time. Since many, if not most, life insurance policies have a set death benefit, a portion of the funds paid as your death benefit is really your cash value coming back to you. With a set death benefit, the insurance company is actually responsible for the difference between your cash value and the death benefit value. What this means is that as you get older and your policy has higher cash values, thus a lower insurance benefit amount, the amount for which the insurance company is charging their cost of insurance or mortality cost is dropping. The cash value is money in your pocket that you can borrow against or withdraw if necessary. These funds are able to grow tax deferred or in many cases tax free. If you borrow or withdraw any of your cash value, your death benefit will drop accordingly. If you have a $100,000 death benefit, you borrow $10,000. If you pass away, the insurance company is going to pay off the $10,000 and give your heirs $90,000. Pretty simple. As the policy value increases, though, you may be able to borrow up to 90% of that number tax-free at relatively low interest rates. Now, be aware that funding your insurance policy quickly may result in your policy withdrawals being treated as if it were from an annuity, that is, with taxable gains coming out first. Policies funded this way are called modified endowment contracts, or MEC. Even with a non-MEC policy, if you don't repay the money borrowed from your policy, it may be taxable as income. So Also, in this case, if you're younger than age 59 and a half, you may be penalized with that extra 10% federal tax, and if your state charges a tax, that too. All right, so just like you would with an annuity in that case. Because there may be complexity to different policies you want to consider, you definitely want to consult with a financial professional who's well versed in these different insurance policies. And together you can determine what insurance products and how much coverage would make the most sense for you. If you think about your life and what it was like 20 years ago, or what it might look 20 years in the future, well, you can appreciate different perspectives we gain as we make this journey through life. Like any journey, we can expect to encounter delays, detours, emergencies along the way, so it helps to be prepared. Adopting life insurance strategies for your different life stages can help you do that. Now, it's not saying that everyone in the same age group has the same life insurance needs, but they're more likely to share certain common financial needs and goals than those who are 20 years older or 20 years younger. So that's why we break them up here. For example, a young couple with a new baby and a huge mortgage aren't going to have the same needs or insurance concerns as a couple preparing for retirement. So keeping that in mind, let's review possible life insurance needs and how life insurance can be incorporated into financial strategies for different stages of life, from young investors to retirees. If you're young, single, childless, you probably don't need life insurance. Yet because life insurance is primarily used to provide income for someone who needs financial security, if you have someone who's tied to you, you may yet need it. Now, some financial experts also say that it's worth considering getting life insurance at a young age because the premiums are relatively low for young and healthy people. If you're newly married, you and your spouse are now financially tied together, so you may want to look at life insurance as a way to replace future lost income and cover any large debts, like a mortgage on a home. If you're raising a family, life insurance can play an even more critical role. A few years ago, the USDA, Department of Agriculture, estimated that parents could expect to spend about $233,000 on food, shelter, and other necessities through age 17 for a child born several years ago. Now, if you add projected inflation, that figure goes up another $50,000 to $284,000. And another consideration for many parents is how much they want to contribute toward their child's education. So based on calculations provided by the College Board, college expenses for a child born in the last few years can be about $267,000 for a 4-year degree at a public university. Now, private universities, even more expensive, $528,000. All right, gets right up there. Now, these financial goals can be challenging even with two parents contributing and may be impossible if the family faces unfortunate circumstances and one of the parent passes away. In that situation, life insurance might be the best option to provide for that surviving spouse and to help your children go to college without accumulating debt. For those in their middle years with no spouse or no children to provide for, life insurance again may seem like a waste of time and money. But don't make that assumption without first weighing the potential benefits. For example, are there any family members, friends, charities, organizations that rely on your financial support? Will the assets you entrust to them through your estate plan be sufficient support for them after you're gone? And don't forget about yourself in the future. We hope you have in retirement. If you'd like to invest in your own financial security, you may want to consider life insurance as a way to accumulate additional tax-deferred or even tax-free wealth. Now, life insurance can be a financial asset. Now, these are just two of the many reasons for adding life insurance to your strategy. Later on, once your kids are on their own, you retire, or your priorities shift, your life insurance needs are likely to change. Maybe no one depends on you financially anymore. You've paid off your debts, you've accumulated substantial financial assets, you're what we consider financially independent. So even though you may not need it as much as you did when your kids were young, you may find that life insurance can still provide valuable benefits for you and your survivors. You can use it to support your favorite charities, for example, or set up a trust for your grandchildren. Now, we're going to talk more about trusts here in a minute. Now, your life insurance may also help your heirs to pay estate taxes on the transfer of your property without having to sell off or liquidate anything. Estate taxes are levied by the state and federal governments on the transfer of property at death. No secret there. That property includes real estate, jointly owned property, tangible property, life insurance benefits, employee benefits, and other assets. The taxes are paid out of the decedent's assets before the assets are distributed to heirs. Now, because of recent laws, the 40% tax bracket that we have now only tends to impact the country's most wealthy. In 2024, as an example, that tax is levied only on the portions of the estate that is valued more than $13.6 million or $27.2 million for a married couple. But I want to throw a quick note in here. As the laws currently read, that increased tax exemption that we got is slated to revert to pre-2017 numbers plus inflation on January 1st of 2026, just a year and a half down the road. If nothing is done before then, we expect the exemption to drop to around $6 million per person in 2026. At that time, the maximum estate tax is also scheduled to increase from its current 40% level up to 45%. So if you have, let's use a big number. You have $1 million over that exemption amount, 45% is $450,000 out of the $1 million. That's a pretty hefty tax. If these changes affect your situation, you'll want to consult a professional earlier rather than later. Don't wait until the last minute because everybody's going to be jammed. All right. Now, we encourage you to watch our newsletters for updates on this scheduled rent increase. Rent increase, you can tell where I am, on this scheduled tax increase. So remember, the beneficiary is the person who gets the money when the insured passes away. Now, your spouse is a logical choice for the beneficiary on your life insurance, right? Well, that's true, particularly for older and married couples. But there's another option you may want to consider, a trust. Now, a trust takes away some of the potential burden for the surviving spouse who may not be comfortable managing a large sum of money from a life insurance policy. A trustee, maybe a banker, an investment professional, a friend or family, would be in charge of investing, managing, and distributing the policy proceeds for the benefit of the surviving spouse. Another consideration is to have a contingency plan for beneficiaries. So be sure to name a contingent beneficiary or a secondary beneficiary in case the primary beneficiary has died or goes at the same time with you. In that case, insurance proceeds will go to a named individual. Oftentimes, trusts are set up to benefit adult children or minor grandchildren. If you're in the position that your life insurance proceeds might get added to your taxable estate, there are other tools, such as an irrevocable life insurance trust or ILIT, which can help get away from those income taxes as well as the 40 to 45% estate taxes. Now, if no contingent or secondary beneficiaries are named and the primary beneficiary passes away, the death benefits for the covered decedent must go through probate court and are to be distributed in accordance with the decedent's will. And of course, if there's not a valid will, the beneficiaries will be determined according to the laws of your particular state. Probably not what you want to have. All right? So please plan ahead to avoid these kinds of issues. It's important. Now, if you're a business owner, you may want to ensure that a family member or partner who's active in the business can be successful in taking over the business when you're gone. Life insurance is often employed as the funding agreement on a buy-sell agreement. Okay, a buy-sell succession strategy, even with multiple partners. The death benefit provides the cash, enabling the beneficiary or beneficiaries to buy out the decedent partner's share of the business and continue operations, and thus providing value to the decedent's family as well. Now, one of the biggest threats to small business is the loss of a key employee, which is a term that we like to use for any employee whose death would create a disruption in the business because of the loss of their experience or unique skills. Now, using life insurance and a key person business continuation plan can help provide funds needed to replace lost revenue while hiring and training a new replacement. Another reason for business owners to consider life insurance is its ability to be used as a supplemental benefit to attract or retain key employees, including executives. Now, life insurance has been used frequently to fund deferred compensation arrangements and to supplemental life insurance coverage for key executives. This can be particularly beneficial if they have difficulty getting insured themselves. As part of a group policy, often you can find better coverage for cheaper prices. Death is not the only reason we have insurances. We know, sadly, that death isn't the only hardship we should prepare ourselves and our families for. Disability and the need for long-term care while you're living can also cause extreme financial distress for individuals, couples, families. Now, most people are going to need long-term care sometime in their life. The U.S. Department of Health and Human Services issued a report a few years ago stating that someone turning age 65 today has almost a 70% chance of needing some type of long-term care services and support in their remaining years. 7 out of 10 people. Look at the 10 people around you. 7 of them are likely to need some kind of care. Now, disability insurance and long-term care insurance can help cover your living expenses if you become disabled or chronically ill. The coverage includes a range of rehabilitative, nursing, and social services for those who need that ongoing assistance. Although it is used primarily by older adults who need help for bathing, dressing, eating, or other essential needs, long-term care insurance can be used by individuals at any age who may have become debilitated by an accident or an illness. We see this often enough that it's a major concern. Now, currently, we're finding numerous people are concerned about providing for that long-term care insurance. Hybrid policies, notice the term here, hybrid policies, which combine coverage for life insurance and long-term care benefits into a single policy, may be an effective way to meet both needs cost effectively. We will be having a seminar that includes information on long-term care. It's coming up on Saturday, June 22nd of this year, 2024. If you would like additional information on that seminar, please reach out to us so you can join us. Now, to finish for today, let me bring up Mr. Chinche, bring him back up. Manny?
Thank you, Brent. Okay, we're winding down now. Here are the topics that we've covered today. We begin by exploring how people can benefit from life insurance. We reviewed how to determine the amount that you need. We discussed what needs it can fulfill and how it can support financial strategies people may want to adopt for different stages of their lives. We talked about the 2 primary types of life insurance, permanent life and term life, along with their uses, and then dug a little deeper into possible life insurance needs at different life stages. We covered some reasons why business owners may want to incorporate life insurance into their business plan, and we finished up by talking about risk assessment and the benefits of long-term care and disability insurance. We hope today's presentation has provided some clarity for you about the different perspectives, benefits, and options related to life insurance at various life stages. There's a lot more information to absorb, but I hope you now have the basics you need to identify and anticipate your own life insurance needs and begin to act on them. We covered a lot today, so what can you expect from us at the advisory group? Now, one of our main focuses is to review changes for our clients on an ongoing basis. You can expect regular communication, more frequent discussions, and you can expect that we're continuously reviewing economic, tax, estate, and investment issues for our clients. We then work to summarize what is important that our clients need and then do that regular communication that we discussed above. So look for more communications about the 2025 tax sunset. In fact, as we noted earlier, we will be offering other workshops that highlight tax changes and planning ideas. As always, we're thankful for the opportunity to assist you with your financial needs. Remember, at our firm, clients come first, and your health and well-being is our highest priority. Of course, there are important disclosures that need to be made, so please pause the slide if you need additional time to read this information. This concludes our presentation. We have included information here for you to reach out to us should you need to. We are glad to be of service. Thank you again for viewing and have a great year.